What's up everybody, welcome back to Earn It, Save and Invest It. In this video, I'm going to break down how I think HIMS can get to $100. Now it's going to take a little bit of time, but I do believe it can get to $100. So if you are buying now, if you're investing now, it might be a good time. So I'm going to break it down using some simple math, also some estimates that they have announced themselves. So I'm just going to go over it really quick, really fast, and try to break it down simply. So if you can, please give a like and subscribe. I really appreciate it. Thank you very much for everyone who is already subscribed and likes my videos, but let's break this down really quick. So HIMS, right now I do put my money where my mouth is. This is my $100,000 challenge that I'm doing. I own HIMS. I have, 45 shares. That is worth $1,500, and I'm up $500 on it. So I put about $1,000 worth in total of HIMS. My average cost is $24.13 right now. So I'm up about 46, almost 47% on it. I used to have 50. I sold 10 shares at 58. And then I bought 5 shares at around this price last week. So yeah, I do believe in HIMS. So I'm just showing I am a owner of HIMS, and yeah. So HIMS itself, over the last just 1 year, you can see it's gone up 28%, right? It's gone up 28%. Its EPS is 48 cents, and its forward PE is 74, which is pretty high, but it does have a high, it is a high growth stock. So that's going to happen when you have a high growth stock, you're going to have a high forward PE. Now, I do want to kind of quickly show why I think it can reach that. So they did announce in the Q3 earnings that when they shared their first 2030 goals of at least $6.5 billion in revenue and 1.3 in adjusted EBITDA, it was clear with this vision in mind to redefine modern healthcare that can look like for consumers everywhere, right? Basically, what I was looking at is their goal of $6.5 billion in revenue, right? So they are currently doing 2.2 billion. Now, they did have it in there. I think it's I don't know if it's at the top of this one. No, their other earnings that they do plan to have between 2.33 and $2.35 billion in revenue, which does put them at, if you look at their earnings estimates, $617 million in revenue. So let's just say they make 2.35, right? I put it right here on the calculator, right? 2.335, this is the minimum in revenue this year. Now, over the next 4 years, right, if they want to get to this number, right, $6.5 billion minimum, they said at least $6.5 billion by 2030. That means they have to be growing their revenue by at least 30% every year. They have to be going by 30% every year. Now, if you do look at their recent earnings, their revenue growth is not nearly as much. I mean, it's more, right? It is more. You got 83, 44, but it's now starting to go down. As you can see, we went from 110% to 72 to now 49. And if you look at the next revenue, if we're looking at, it's going to be 617, we're looking at about 30% or so compared to the 481 million. So their year over year when it comes to revenue is going down a little bit, but they've also had some of their issues with Novo Disc and all that stuff. But I do believe that things are going to shape up. I think that they're going to be able to grow their revenue at least 30% per year, if not more, over the next coming years. And some of the reason I do believe that is because they're bringing the weight loss program to the UK. I'm not going to break all of this, I'll break it down really quick, right? It's bringing access to its comprehensive weight loss program to the UK after a detailed clinical assessment by GMC registered doctors. Eligible customers can now access transparent pricing and personalized weight management programs. These plans may include branded GLP-1 treatments such as Mounjaro or Wegovy, as well as a non-prescription oral option, Orlos. All customers will have access to comprehensive support, including 24/7 care team, blah, 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 all this, right? So they are now going into the UK, which is great. They are now, even though their revenue was based on what they're currently doing, it's not based on their growth that they're going to be having, right? So they are growing different avenues and different ways. They're just expanding in general, right? They're now serving Canada with the LiveWell acquisition. They bought this company, LiveWell. It's a Canadian digital health platform focused on weight loss treatment. To best serve its Canadian customers, Hims and Hers establishing dedicated local leadership. Canadian business leader Austin Curry will take the helm in market as the general manager of Canada, working closely with Hims and Hers advisor and new chief medical officer in Canada, Sandy Van. So now they're going into Canada, right? That's just another avenue for them to make excuse me, Jesus, for them to make more money. Another one, which I think is just, this is bigger than revenue. This is obviously not revenue, but this is a way to start tapping into healthcare in a totally different way, I believe. Hims and Hers bought Your Biohealth for blood sampling technology. This is signaling something bigger than just weight loss. I'll be honest, and I'm sure a lot of us would love to have our blood tested for different things, right? Now, of course, you can go in for scans, you can get this, you can get that, but having your blood tested is one of the best ways to really understand how your body is working in certain ways, right? In certain places. We don't know how to do that ourselves. None of us like to go in and get the big blood drawn and all this stuff. Well, this company, Your Biohealth, it uses these called basically micro needles. They are so small you don't even feel anything, and you just put them on, and you can use them for kids. I have 2 kids, and they hate needles, and so I'm wondering, okay, this I would love to do. I would be like, yes, let me test for this. Let me test that. Let me check out for this. I would start like doing all of these different tests to see what my blood and what my body consists of and how it's working, right? So I believe that is huge, right? They've entered into an agreement to acquire Your Biohealth, a Boston-based maker of a capillary whole blood sampling technology. Financial terms weren't disclosed. The all-cash transaction is expected to close in early 2026 and would be funded from Hims and Hers balance sheet. That's something to keep in mind. The acquisition combines Hims and Hers wellness platform with Your Bio's patented virtually painless microneedle technology to modernize the overall blood collection experience. It's amazing from what I was seeing on their YouTube, and it's a small company, right? It's not like they patented their technology. They were really working on it, and so they wanted to get this into some hospitals and other healthcare because people don't like the needles, right? Especially for kids. That's what it was really showing, was kids. You can have this little thing, and tap it on for the kid, and it's just it's almost like a toy, like a little plastic thing. It's amazing. And so I do think that is going to be something bigger, right? Hims is really working towards the personalized Medicare healthcare platform. If you want personalized, you have to know what your body's made out of. You have to know what it takes, what it likes, what it wants, what it doesn't want. So I believe that's going to be huge, and that's a bigger play. By 2030, I think that will be more in play. Last one I really want to show is they authorized 250 million share repurchase program. So this was after their Q3 announcement. So in their Q3, they still had about, I think, 55 left, and they announced a $100 million buyback a while ago, but in 2024, and then they had about 50, I think it was 30 or 55 left on that. And then they just announced this to do 250 million. See the 100 million in 2024, which has now been fully utilized. Okay, so they fully utilized it by Q3. They didn't. they still had, I think maybe it was 30 left. And then they used all of that, and they said, look, we want to buy more of our stock, because they understand, they believe in the company, right? The company believes in itself, and so they want to start taking some shares off the table, which is great for earnings per share, because now when their earnings is going up, their revenue and income, their profit is going up, but there's less shares out there in the world, your share is worth more now. So it's good that they are taking shares off the table. And if we look at their financials, if we just quickly look at how they're doing it, right? The cash flow, come on. Here we go. The repurchase of common stock, I mean, we look at they've been repurchasing a lot more than usual. Right, in December 2024, just the year 2024, and then the last trailing 12 months, they have been purchasing a lot more in terms of their stock. Right now, if they hadn't been doing that, and if they hadn't been making purchases for different companies and doing all these big other moves, their net change in cash would actually be a lot bigger than this. Their income would be bigger, but they're investing for the future. So, when we're, actually, look at this. When we're looking for a company that we, want to invest in, at least for me, when I want to invest in, I want a company that is profitable. It's either working really well towards profitability or on the brink of profitability, or just plain out profitable. And they are always thinking about the future. They are making moves, and you always have to understand CapEx, capital expenditures, investments, and mergers, and buying back the stock and buying out other companies and stuff is all part of the process. And I think that it's part of a successful process if done correctly, and I think HIMS is doing it correctly right now. So I just wanted to go over that really quick. Now, again, if they grow at a 30%, right? It's 29.5% to get at 6.5 billion. Now let's just say the stock grows at about the same, right? Let's just say it grows at about the same. Well, over the next 4 years, what is the stock at, right? We had it at 35. Yep. So let's put it at 35 over the next 4 years. It will grow 30%, and you're talking about $100 stock. Now, it did almost hit $100. I mean, okay, that's over exaggerated. It hit about 70, right? Let's look at it really quick. It hit almost 70. It actually did hit 70 back in, February 2025. Never saw 70 once more in July, and then it just has tumbled since, right? So obviously, it still has plenty room to jump to 100, even from that point, right? If you had bought here at 70, and you still get to 100, what are we talking here? We're talking is 42% profit, right? So that's pretty good, and that's if you bought it at its highest that it's really been. Now, if you buy it today at 35, let's just say it's at 36, right? And then you buy it at $100, now you're talking 175% profit over the next 4 years, which, when people see Palantir and Rocket Lab and Teslas and, the GameStops of the world, whatever, it can get really easy to be like, I'm only going to triple my money. I'm only tripling my money over the next, few years. Like, you're not even tripling it exactly. You're kind of going less than tripling, right? People don't like that. People don't like that in the sense of people think a lot more short term. They want to double, triple their money in 1 year, which is just not realistic if you want to talk about doing it on a consistent basis. If you want to look into buying into stocks that are going to be good over the next 5 to 10 years, you look over the next 5 to 10 years, you say, this is what the numbers say, this is what things look like are going to be, this is what the future looks like, this is what this company is looking like, this is what the market and the world, this is just kind of take a view of things, I have messed up by not just taking that view and really sticking to it. I was doing more trading, I was doing more personal stuff, and I didn't do it. So I've dedicated my life now to do a little bit better at that. So I do believe over the next 5 to 10 years, I'm going to be a lot more successful at this, and I'm going to be in a way better position. Right now, obviously, I just started this challenge. I started in June 2nd. So, it's gone up a little bit. Started at 7,354. Now I'm at almost 9,000. But I also I started my project. I started my challenge June 2nd, which was May, right here. Literally right here. I mean, it was way up here. It might have been over here. It might have been at 58.60, but it was way up there. I mean, it was $60 or so. Like I said, my average is at 24. So I was doing a lot better than I am today. So, it is what it is. But again, I just wanted to express how I do think HIMS can get to $100 in about 4 years if it grows at about 30% a year from where it's at currently. And you have to remember, it could go a lot higher. It could jump to 200, and it could jump to 200 in 2 years and then work its way back to 100 over the last 2 years, right? The way the stocks work, the stock price, it's not relative to the actual business. As much as it can be, it also doesn't necessarily have to be. You look at Palantir, right? It's like one of the top, highest valued companies in the world. It's like top 30, I believe, right? Still, and the revenue and the income is not even close to any of those companies up there. But the stock price has jumped up so much that that's just the value of the company. So HIMS, I do believe, by the end of 4 years can get to $100. Again, some people might not think that that's a great return, but let me show you what a 30% return does. I'm going to show you this. And if you don't believe that this is a good thing, let me show you exactly what 30% does. Let's say you have, let's go 30%. Let's say you have $1,000, and you're going to save for the next 20 years, and you're going to put $0 into it. Your $1,000 over 20 years at a 30% return is going to get you $190,000. $190,000 from 1,000, 20 years. You put $0 in after that. You let it grow. It just grew for 30% on average, 30% every year. 190,000. So even though, 30% at first doesn't sound great, check that out. That's 30%. $1,000, 20 years, 30%, zero more contributions, $190,000. You invested $1,000 and you gained $189,000. It's just simple math. So again, people, and it doesn't mean that HIMS is going to go 30% for 20 years, right? But if you're able to find companies that can grow at a 20 to 30%, let's do 20%. Let's just do 20%. That's still good. Now, a lot of people are like, oh no, right? You feel like you just lost so much money. You feel like you just lost $150,000. But you just had $1,000 grow to almost $40,000. Now, let's change it up a little bit. Let's say every month you invested just $100, just $100, just $100. You start off with $1,000, invest $100 a month. Now you have 262 after 20 years. It's 20% return. Now, granted, 20% return is on the high end, but I'm just showing you how little it takes. If you have that kind of return and you find companies with that return and you're able to do it on a consistent basis, in 5-year chunks, right? If I look at him, I'm like, look, I'm gonna get a 30% return on my investment per year over the next 5 to 7 years. I will do that, because then after 5 or 7 years after I've done that, and if I revisit, I'm not going to be revisiting. I'll be watching it all the time. But let's just say I revisit the big. Okay, am I going to stay committed to this, stay invested into it? Well, then I can make that decision then. But once I cash out, like, okay, now on to the next one over the next 5 to 7 years is going to probably return me the net, right? So then, even though I'm not invested in one stock that has to return over the next 20 years, 20 to 30%, I'm keeping my mind and my eyes open for those stocks that can return that, and then I'm buying into those, right? So that's just my opinion. That's just what I'm doing and what I think HIMS can do and why I think HIMS can reach $100. So be ready, because I do believe that this stock is poised. I was saying buy in this box, and I do believe that now it is going to really start moving up. As you can see, it's starting to push up a little bit, and it's hitting a point where it really hasn't touched this. It was all this year, but it initially touched this level November of 2024. So it's been a year and a couple months. So let's see, hopefully it bounces off that level. I don't see it dropping down to these levels. I just don't see it dropping down there. So just remember, when it comes to investing in stocks, always just be ready, be aware, and be prepared, but don't be scared. Always consistently invest, and never forget to earn it, save it, invest it, buy low, sell high. I want assets, not liabilities, and you can count on compounded interest.